how does a tech titan lose, $14.7 billion in 6 months, but somehow like triple the actual cash in his bank account?
Yeah, it completely defies basic intuition. I mean, when you see a net loss of that magnitude, the immediate assumption is just, well, you assume the core business is collapsing under its own
Yeah,
weight.
terrifying, right? But then you look at the exact same financial period for the exact same company, and the underlying cash flow is suddenly surging.
Right.
The flashing red siren suddenly looks a lot more like a lighthouse.
Exactly.
We are talking, of course, about the August 2026 turnaround story of Intel. Welcome to Market Pulse Daily, and today we are doing a complete deep dive into a massive stack of forward-looking equity research on Intel.
It is a wild situation to unpack.
It really is. Our mission for you listening today is to understand this aggressive pivot into the $2 trillion AI hardware boom. We're going to look at the massive gamble of a $20 billion stock dilution and try to figure out whether this stock, which is already up a staggering 267% over the last 52 weeks, still has room to run.
Or if the market has just gotten completely ahead of itself.
Right. But before we get into the catalyst stack and what actually changed today, a quick reminder for you. We are utilizing StockOracle as our master guide for this research.
Yeah, it's a fantastic tool for tracking these massive data shifts.
Absolutely. And there is a link for a 14-day trial in the description of this deep dive. As always, full affiliate disclosure, we do earn a commission if you sign up through that link. And we have to state clearly that AI insights and intrinsic value estimates may be wrong, and standardized data can be delayed.
You always have to do your own due diligence.
Always. Okay, so let's unpack this, because we have to start with this wild disconnect between the money on paper and the money actually in the bank. What is the confirmed development here?
Well, we have to look at the mechanics of heavy industrial manufacturing. When you're evaluating a turnaround of this scale, especially for a manufacturer, the accounting reality and the cash reality often tell, two completely different stories.
Let's lay out the numbers for the listeners, because looking at the second quarter of 2026, the revenue side actually looked incredibly strong.
It really does.
Yeah, Intel hit 16.1 to $8 billion in revenue. That is a 25% year-over-year jump.
Which is massive for a company of that size.
Right. And according to the research, that's their fastest growth rate since 2011. So the demand resilience in their core client and data center franchises is, it's undeniable.
Yeah, which proves the foundational product is moving, right? People are buying the chips. But the conflict arises when you zoom out to the first half of 2026 as a whole.
The $14 billion elephant in the room.
Exactly. They posted a net loss of $14.761 billion.
Yet, and this is the catalyst hook here, their operating cash flow almost tripled.
Right.
It went up to $8.102 billion compared to the prior year. And to add another layer to this puzzle, their capital expenditures, meaning, the money they actually spend on building physical assets and factories.
Right, what we call CapEx.
Yeah, CapEx, that dropped by 29% down to $6.192 billion.
So you put all that together and it creates a positive free cash flow proxy of $1.910 billion.
Which is a huge swing. Because the year before, that number was a negative $6 billion outflow. I mean, I was trying to wrap my head around how you lose nearly $15 billion on paper, but still generate almost $2 billion in usable cash.
It's all about how accounting rules handle physical assets.
Right. Think of it like renovating a massive historic hotel. You bought this place, it's totally outdated, and you're pouring capital into fixing it up.
Okay, I like this analogy.
So, on paper, your depreciation costs and all the accounting write-offs for the old, obsolete building materials make your net loss look absolutely terrible. For tax purposes, you basically look like a failing business.
Right. The financial statements are a disaster. But down in the lobby, the dynamic is entirely different.
Exactly. Down in the lobby, guests are finally booking rooms. Again, that's your 25% revenue growth. And you just decided to, temporarily pause buying those incredibly expensive gold fixtures for the bathrooms.
Which is the CapEx dropping.
Right. So even though your financial statements are bleeding red, the actual cash sitting in the register at the end of the day is suddenly way up.
And why this matters, what's fascinating here is that for a capital-intensive manufacturer like Intel, that mechanical free cash flow is a far more powerful signal to the market than GAAP earnings.
GAAP being the standard accounting principle.
Right, generally accepted accounting principles. GAAP forces companies to include all those non-cash charges like the depreciation of factory equipment.
The old hotel materials.
Exactly. During an intense investment cycle, those accounting rules can make a company look artificially grim. But free cash flow, that is the raw oxygen of a business. Moving from a deeply negative $6 billion outflow to a positive $1.9 billion means the core business is finally funding itself again.
So it's the ultimate proof of capital efficiency,
It really is.
which sounds fantastic for anyone holding the stock.
Ugh.
But here's where I want to push back on this. Because if the cash flow is suddenly looking up and the oxygen's flowing, why has the stock experienced a violent 11.25% pullback in just the last 5 days?
Yeah, that was a brutal week.
The market clearly panicked. And from our sources, the market interpretation seems to center around how they are choosing to fund the rest of this massive hotel renovation.
Right. The market was suddenly forced to swallow a massive capital raise. Intel recently upsized and priced a $15 billion to $20 billion common stock offering.
So they're just issuing a ton of new shares. Context is really crucial here for you listening. Intel's total debt sits at around $50.5 billion, and they only have about $12.874 billion in cash on hand.
And we have to factor in the catalyst stack here, specifically the macro environment.
Right, the broader economy. We are seeing 30-year Treasury yields hitting 19-year highs.
You absolutely cannot ignore that. When the 30-year Treasury yield spikes, the risk-free rate of return goes up. So if an institutional investor can get a guaranteed high yield from the U.S. government, they're going to demand a significantly higher premium to take on the risk of a messy tech turnaround.
It makes Intel look way less attractive by comparison.
Exactly. That dynamic is hammering semiconductor valuations across the board right now.
And technically speaking, you can actually see the strain on Intel's stock chart. The research notes it is breaking below its short-term 20-day moving average and its medium-term 50-day moving average.
Which is a clear bearish signal in the short term.
Right. For those listening, moving averages aren't just, arbitrary lines drawn on a chart. They are psychological floors where institutional algorithms typically step in to buy.
So when a stock breaks below them, it signals short-term exhaustion.
Exactly. Now, the 200-day long-term trend, which sits at $70.99, that is still intact. But the short-term picture looks really bruised.
It does.
So what does this all mean for you, the investor? I look at this $20 billion stock offering, and I just see the brutal pain of dilution.
Yeah, no one likes dilution.
I mean, forget the old cliche of slicing a pizza into more pieces. If I own a share, I feel like management just forced me to bring in millions of new co-owners for this hotel we were talking about.
Right.
Sure, the lobby gets fixed, but my personal cut of the daily room profits just permanently shrank. Why inflict this kind of financial self-harm right as the cash flow is recovering?
Because management is looking at a survival equation, not a short-term profit equation. Intel is making a calculated, agonizing gamble because they simply require that $20 billion to stay in the race.
They just need the cash that badly.
Desperately. Their projected CapEx requirements for 2026 exceed $20 billion alone. Building cutting-edge semiconductor fabs is arguably, well, it's the most complex and capital-intensive manufacturing undertaking in human history.
So the cash flow is improving, sure, but it's nowhere near enough to cover a $20 billion annual construction bill.
Nowhere close. They are trying to build the factories of the future while keeping the legacy business of today afloat. Management basically faced a binary choice.
What are the options?
They could slow down the turnaround to avoid diluting shareholders and risk falling permanently behind Taiwan Semiconductor.
Which would be a death sentence.
Right. Or take the extreme short-term pain of dilution to secure the capital needed for long-term relevance.
Which brings up a huge open question. Where exactly is all that $20 billion going? What are they building that is so critical they'd wreck their own stock price in the short term to fund it?
The foundry pivot.
Right. The research makes it very clear they are making an aggressive all-or-nothing bid to become a global foundry. They don't just want to design their own chips anymore. They want to build the physical chips for everyone else.
They are taking on TSM directly, and that represents a monumental shift in their entire corporate identity. For decades, Intel's impregnable moat was a closed ecosystem. They designed their architecture, and they printed it in their own factories. Now they are kicking those factory doors wide open to external competitors.
Okay, so the crown jewel of this open door strategy, according to the research, is their 18A node, which utilizes high-NA EUV technology.
Yes.
And the Catalyst stack highlights that they already have Apple and Microsoft lined up as design partners, which sounds like incredible validation. But for those of us who don't have engineering degrees, what exactly is high-NA EUV and why are companies like Apple betting on it?
Okay, so EUV stands for extreme ultraviolet lithography. To put it simply, modern chips require billions of microscopic transistors. You can't carve those mechanically, you have to print them using light.
Right, like a microscopic photograph.
Exactly. EUV uses wavelengths of light that are unimaginably small, allowing you to print circuits at an atomic scale. The high NA part, which stands for high numerical aperture, essentially means upgrading the lens of that light system to be even sharper.
So it's basically a better lens for printing tinier circuits.
Exactly, which allows for even denser, more powerful AI chips.
But here's the catch that the research focuses on. All of this incredible technology hinges on a single make-or-break near-term catalyst.
The October deadline.
Right, the targeted October 2026 release of something called PDK 0.9. Now, they'd really dig into the sources to grasp this. The best way to understand a PDK, or process design kit, is to go back to our construction analogy.
Okay, let's hear it.
A PDK is essentially the master architectural blueprint and the strict building code given to an external contractor. If Apple wants Intel to build their next revolutionary chip, Apple's engineers can't just guess how Intel's high-NA EUV machines operate.
Right, they need the exact specifications.
Exactly, the physics of the transistors, the wiring rules, the thermal limits. Without that PDK blueprint, companies like Apple literally cannot design chips for Intel's factories to build. It is a total non-starter.
The PDK is the fundamental translation layer between the external designer and the physical factory. So looking at the timeline, the release of PDK 0.9 on October is the ultimate credibility test for Intel's entire foundry pivot.
So the business impact here is huge.
Massive. If they hit that deadline, it proves to the market and to massive clients like Microsoft that the 18A manufacturing technology is stable, predictable, and ready for commercial volume.
And here's the massive risk if they miss that October deadline.
The entire foundry thesis fractures because right now that foundry business is bleeding capital. It is currently dragging their trailing 12-month net margin down to a brutal negative 19.79%.
Let's unpack that specific number because the financial impact is staggering. For every single dollar coming into the foundry side right now, they are burning roughly 20 cents in pure loss.
Right. And if the PDK is delayed, those massive CapEx construction bills keep piling up, but the actual revenue from external customers gets pushed out indefinitely.
Ouch. So the longer the delay, the more that $20 billion shareholder dilution starts to look like a sunk cost rather than a brilliant strategic investment.
It is incredibly high stakes. It works or it doesn't.
But while everyone is hyper-focused on this massive 18A foundry gamble, the research points out that Intel has a secondary, potentially much faster engine to tap into the AI hardware boom.
Yeah, this is fascinating.
It's almost like an AI backdoor, and it's called advanced packaging.
Advanced packaging is easily the most underappreciated dynamic in this entire report. The market obsessively tracks the leading-edge logic chips, the microscopic brains printed by the EUV machines.
Right, the glamorous stuff.
But they ignore the physical assembly required afterward.
So instead of printing the brains, advanced packaging is about taking finished individual chiplets from different manufacturers and stitching them together like incredibly high-tech Legos to create a single AI superchip.
Exactly. And there is a fascinating market dynamic creating an opening here. Samsung, a major competitor, is reportedly raising their foundry prices by up to 15% because global capacity is choked.
Everyone on the planet wants AI hardware right now.
Right. And there simply aren't enough factories to package it all together. This creates a massive pricing and market share opening for Intel to step into today.
So if we connect this to the capital expenditures we discussed earlier, advanced packaging is profoundly strategic. Getting a leading-edge node like 18A to run perfectly at mass scale takes years of microscopic refinement and hundreds of millions of dollars per EUV machine.
It's unbelievably expensive. But advanced packaging relies on slightly older, more established physical processes. It is significantly less capital intensive.
Meaning they can generate revenue without burning quite as many billions to set it up.
Precisely. It offers a near-term revenue catalyst. While the broader market waits for the 18A node to ramp up production over the next 2 years, Intel can exploit Samsung's price hikes and TSM's maxed-out capacity right now.
They can just generate high-margin cash by assembling the AI chips the world is desperate for.
Exactly.
And we can't ignore the massive external advantage they have, something that doesn't show up on a traditional balance sheet.
The government backstop.
Yes. The U.S. government directly holds a stake in Intel now. Through the GPS Act funding and grants, Intel is a direct beneficiary of domestic industrial policy. Now, just to be clear for you listening, we aren't taking any political sides on industrial policy here. We're just reporting on the financial reality of the source material.
Right, strictly analytical. The United States government has recognized that advanced semiconductor manufacturing is a critical pillar of national security. Allowing the entire global supply chain to remain bottlenecked in East Asia is no longer tenable for them.
So the government is providing a substantial safety net.
Yes, it aligns federal interests with Intel's corporate success in a way that competitors simply do not enjoy.
Okay, so let's synthesize all of this. If you are an analyst or an everyday investor trying to calculate a fair value for this stock, you are wading through a staggering amount of noise. You have massive shareholder dilution and $14 billion gap losses on one side of the scale.
Balanced against 25% revenue growth, Apple partnerships, and the financial backing of the U.S. government on the other.
It is a violently bifurcated dataset. So our sources lay out two primary frameworks to interpret this. First is what they call the blue sky scenario.
Which is the absolute optimistic view.
Right. Now, we need to explicitly state this is an optimistic scenario, not a prediction of what will definitely happen.
Very important distinction.
But in this blue sky world, Intel sustains that 15 to 25% revenue growth for multiple years. The 18A node and the PDK 0.9 execute flawlessly in October. They return to GAAP profitability, and the market decides to re-rate Intel.
Meaning they strip away the turnaround discount and award it the premium valuation of a dominant global foundry.
Right. That scenario is the absolute home run, transforming Intel from a struggling legacy giant into a multi-platform semiconductor titan.
But then there's the base case, which the research actually rates as a neutral 5 out of 10.
And the reality check here comes down to valuation multiples. Yes, the fundamentals are improving, but remember, the stock is already up 267% over the last year. It is currently trading at a price-to-sales multiple of 9.3x.
We need to pause on that number.
Yeah. You are paying $9.30 for every $1 of sales, not profits, just top-line sales.
A multiple that high indicates that a significant portion of this recovery, the cash flow inflection, the revenue bounce, even the potential success of the 18A node, it's already priced in.
Investors are paying a premium for good news that hasn't fully materialized yet.
Exactly, which makes the upcoming Q3 revenue guidance of $15.8 billion to $16.8 billion an immediate stress test.
Right. If they miss that target by even a fraction, the stock could get severely punished because perfection is already baked into that 9.3 price tag.
Making sense of this, balancing the trailing accounting losses against the forward-looking technological catalysts is, well, it's beyond complex.
Which is exactly why the financial sector is seeing a massive surge in AI-aided research web apps like StockOracle. It's fascinating to look at how modern investors are attempting to process this scale of information.
Because manual processing of this many variables across thousands of equities is becoming computationally impossible for a human analyst.
Right. The research notes that platforms like this cover over 15,700 securities. But it's the how that is interesting. Investors are using features like OracleValue, which calculates intrinsic value estimates by running 9 different valuation models simultaneously.
And the logic there makes sense. A discounted cash flow model might love Intel's $8 billion in operating cash flow, but an EV to EBITDA model might penalize them heavily for that $50 billion debt load.
So by blending 9 models together, the AI smooths out the inherent bias of any single financial metric. They also use OracleIQ to run AI moat analysis.
Right. Instead of just guessing if Intel has an advantage, the AI parses thousands of global supply chain documents and patent filings to mathematically score how defensible their business actually is.
It is an incredibly powerful way to organize standardized data. But this necessitates a massive caveat for anyone using these tools.
Which is that technology organizes the data, it does not eliminate the risk. AI insights and intrinsic value estimates can be completely derailed by human variables. Furthermore, standardized institutional data is frequently delayed, lagging behind real-time market movements.
An algorithm can calculate a blended valuation model in milliseconds, but it absolutely cannot predict human execution.
Exactly. It can't predict if an engineer is going to finish a blueprint by October.
Right. The human investor still has to weigh the binary risk of the PDK 0.9 launch An AI can map out what the stock is worth if the launch succeeds and what it plummets to if it fails.
But you are the one who has to make the final judgment call on whether Intel's management can actually hit that deadline.
And that brings us right back to the core tension of this entire deep dive. Intel sits at a historical inflection point. On one side of the ledger, you have accelerating revenue, demand resilience, and a dramatic improvement in operating cash flow.
The hotel is booking rooms again, and the oxygen is flowing.
But on the other side, you are battling massive share dilution, deep gap unprofitability, and the intense pressure of a high-stakes, multi-billion-dollar foundry deadline.
So, as you navigate this moving forward, our sources have mapped out a very clear three-part checklist of what to watch next.
Okay, let's hear the checklist.
First, the Q3 earnings report in October. That $15.8 billion to $16.8 billion revenue guidance is the baseline. They have to meet or beat it to prove the core business is truly stabilizing.
Got it. And second?
Second is the confirmation signal, the PDK 0.9 launch. If October comes and goes without a public release of that blueprint, the entire foundry thesis takes a massive, perhaps fatal hit.
And third is the primary risk signal.
Right, the technical floor. You want to watch closely if the stock breaks below its 200-day moving average of $70.99. If it drops and stays persistently below that psychological line, it signals that institutional money is rejecting the dilution and losing faith in the turnaround timeline entirely.
It is going to be a volatile few months, without a doubt. From the flashing red sirens of a $14 billion loss to the lighthouse of a cash flow turnaround, the stakes in the semiconductor space have never been higher.
The stakes are astronomical. And as we wrap up, there is one final piece of this puzzle to consider, something that builds on everything we've discussed about Intel's pivot to becoming a global foundry, but steps away from the financial metrics.
What's that?
Corporate DNA. We talked about Intel taking on Taiwan Semiconductor by opening its doors to companies like Apple, but consider the cultural chasm there. TSM's entire corporate identity, its fundamental culture for decades, has been built on ultimate customer service. Their entire existence revolves around serving the external designer. Intel, conversely, has spent 50 years being the absolute dictator of its own closed ecosystem. They built it, you bought it.
That is a massive psychological shift.
The question is, can you simply buy a service-oriented corporate culture with a $20 billion stock offering and new factory equipment? Or will the legacy arrogance of a closed ecosystem giant ultimately clash with the demands of clients who are used to being treated like royalty by TSM?
Wow. Technology is one thing, but completely rewriting a company's DNA might be the hardest turnaround of all.
It's a fascinating dynamic to watch play out.
It really is. Keep a close eye on October, folks. The blueprint is everything. As always, check out the description for that 14-day StockOracle trial link to run these models yourself. Just remember the AI and data caveats we discussed. We'll be watching this Intel turnaround right alongside you.